I'm sure you're curious, like myself, how is this possible that real estate prices are so out of whack with historical valuations and so forth? So this is an interesting story, looking at the real estate market in Canada. Because again, if you look at it from this point of view, this is from the monetary wave, you could see real estate prices are way outpacing inflation, real incomes, and population growth. If you're curious like I am, like, what caused this? How did we get to this point? A lot of people know that I do work on the LongWave, and here's the real estate cycle from 1946 into the 2030s. Now, let me give you a little bit of a story, and again, I want to cover this in detail, so I'm going to be talking over this. One of the things people aren't aware of is that prior to 1940, there was no extended mortgages. So this real estate cycle from 1946 started with long-term amortizations, because during the 1930s there were 5-year mortgages with a 50% down payment were the norm. So that's really interesting. The Dominion Act of 1935, the government provided 20% of the lending value, and the private lenders between 50 and 60%. So really pre-1940, we have a 25-year am. Now, what's interesting, 1946, when this story starts, the gross debt service ratio was set at 23%. Also in 1946, the Canadian or Central Mortgage and Housing Corporation is established. So again, if you think of how you needed to qualify for a home and why house prices were 2 to 3 times income during the 50s, this is simply because you needed a 50% down payment. So historically, there were 2 times income. Today, it's just astronomical. Now, one of the thing is that banks were risk averse, and they wanted to protect the home buyers from defaults. So CMHC was set up to protect, and that's where the conventional deposits were insured. Now, in 1967, the Bank Act was amended to remove the 6% interest rate ceiling on bank loans, including mortgage loans, to allow banks to make conventional mortgage loans. What's also interesting in 1970, which I wasn't aware of, is that they did not allow women actually on the mortgages. So that would explain a lot of things, which is kind of interesting. Now, I'm looking at the data here, and so that explains really the blow-off in the 70s. And by the way, real incomes were rising during that time. So prices stayed within a norm of 2 to 3 times income. Now, in 1972, the gross debt service ratio increased from 23% up to 30%. Well, all that means is more leverage in the market. The next big thing in 1981, we had the deregulation, or after that time, the deregulation of the fire industry. And that's really important if you look at the cycle. The reason is that this is what started the cycle Ponzi finance, right? People look at their cash flow and how much they can carry every month, not necessarily the size of the mortgage. Another important factor is real incomes for the first time in Canada's history started to stagnate. And that's why that chart before, if you look at this chart here, and you see that real incomes have just increased by the slightest amount, but we had this blow off in 2000. Okay, so let's go through the history again. Minimum down payments were lowered many times to gross debt service ratio. So here's the numbers. Gross debt service ratio, 23% in 1946, increased to 27% in 57. In the 70s, it was 30%. In the 70s, second half, we included the spouse's income. In 1981, 31%. In 1981, also the falling price of credit started. We call that the monetary wave. In 1992, it was increased to 35%, the gross debt service ratio. And in 2012, which we have currently, it's about 39%. Now, in the period known as the teens, or 2012 to 2021, we had the falling price of credit, historical lows. And we can see this with the 5-year rate. If you take a look at the 5-year rate, I mean, we've moved up. This is the latest number, 3.7%. We're at the lower range of interest rates. I mean, they should normalize about 6%. This is the long wave, by the way, the Canada 5-year long wave, where we had rising interest rates. And as you see there, we had falling interest rates for 40 years, and that is over. So if you understand all this is just Ponzi finance. Now, is that really true? When we take a look at the measurement of the greatest credit bubble in history was Japan. And look what happened here in the fourth quarter of 2020. We surpassed that. Isn't it interesting that this followed a pattern? It was pretty similar to Japan. And we were going to peak a couple of years ago, but we had the lockdowns and record low interest rates, the lowest in history, and society leveraged from there. I mean, it's absolutely amazing how far we've leveraged. Now, here's something else that's interesting. Look at mortgage credit growth, which peaked in the 70s, and it's been in a secular slowing in spite of falling interest rates. And you can see the green line trend is that we'll be deleveraging, or Canada will be deleveraging by the 2030s, inevitably. I mean, we just have too much unproductive debt. Now that, I believe, could start next year. We're going to find out in 2024 when the demographic headwinds start to really come into play. And here is also Canadian real prices, and you can see from 1970, we had 15 years of stable prices because incomes were rising. And then we had a little bit of a rise, the first bubble from 84 to 89, and then falling real prices until 2000. And then you see the past 22 years where we had the final blow off in 2022. Unprecedented in Canada's history. So it's interesting how people want to justify this blow off. But remember this chart. It's by the way, it's the leverage. So think of it: 2 times income to what is the multiple you're getting today? Maybe 10 to 12 times income. And let's say we include the spouses, so that will fall to about 4. So 50% is the easy call for real estate prices to collapse, because all that run up here is just Ponzi finance. No incomes were rising, because you see from 1970 here to 2000, it didn't vary that much in terms of prices, but this 2000, and especially the last decade, where all the rules of real estate went out the window and everybody's a speculator. And now it's going to reverse. So that's a simple story how we got here from 2 times income until about ridiculous prices. The most important part is now that this cycle starts to unwind, it's going to be devastating to the economy, and we're going to see that in 2024. Really quickly, the website for those people who are interested, if you want to understand more about the long wave, I explain on the website decoding the long wave services. If you're really uncertain what to do with capital, it's just there's a model there, and I'll be having individual consultations for people. My background, resources, there's books on understanding the long wave. If you need to contact me regarding presentations, we're going to have presentations in the future about helping homeowners get through this period. And people know my story. I need to repeat often. I'm sorry about that, but I went through a devastating collapse in real estate, 89 to 94. And I know exactly what you're going through, and we'll help guide you through that process because it's devastating to your family, finances, marital status. Because when you have this kind of collapse, your savings, and I went through that, your savings erased. So obviously you can tell I'm extremely bearish on real estate. Mathematically impossible for it to rise from here, because we have the millennial demand peak next year. We've just went in extreme overvaluation, and it has to correct. Then prices can rise long term, but they have to correct back to historical prices, which is inflation adjusted prices or incomes, and then prices can rise again. And that is 50 to 75% lower, depends where you live. Anyways, one last thing, if there's questions particular about what I do or anything else, this will be posted tonight on YouTube. And I appreciate the questions, because sometimes people think about things I don't think about, and we'll be answering them every week on a something like this, just going through all the questions that you have. Because one of the challenges I have is to simplify the long wave. What does it mean? Why it's a unbelievable forecasting model, right? It's a satellite view of the future, because what is occurring and what will occur has happened in the past, but it hasn't happened in our lifetimes. It's the advantage of a historian. We can see patterns of the past, and we're going through a period in the long wave called economic winter, and that's another story. So I hope that helps and explains how we got into this mess and why it's not sustainable, and we're going into a secular bear market for real estate. More to come to this. One more thing. You will find I'm categorizing on YouTube playlists with long wave. This, of course, would be about real estate. So if you're looking for more videos on real estate, I'm trying to keep them short and to the point. You'll find them in the real estate playlist. If there's anything to do with the political cycle or technology or the long wave itself or the political cycles, I'm going to categorize and separate them so you can get that education. Thanks for listening, and I hope to hear your comments, and let me know. Subscribe, and please let other people know who would be interested in this information. Thanks again.